Recession, or the talk of a recession, whether or not we've had one, whether we're not having one, are we in a recession now, or are we not in a recession right now? Those are all the things that are being debated by all the talking heads in the news right now. We won't know till after the fact. There's actually some arbitrary committee in government that basically decides based on the data after the fact if we are indeed in a recession, and then ultimately how long we were in a recession, all of those different things. But let's just assume for a minute that the popular opinion is correct and that we are in a recession. If we are in a recession, we possibly started that recession in January. The reason we can come to that assumption is that first quarter of 2022, we had GDP, the gross domestic product, the growth of our economy shrink. The second quarter came out just another month or two ago. That again showed a decline. So by the traditional definition, again, there's more that goes into it, but by the traditional definition, which has been fairly accurate in the past, it would appear that we are in some type of a recession. So whether that is a mild recession, a moderate recession, or something more severe, we don't know yet. But suffice to say, we would be somewhere between 7 or 8 months into a recession at this point, if it is confirmed that there is a recession and that we are in one. So let's assume for a second that we are, and let's talk about the market and what the market does and what it doesn't do. So the market typically is a leading indicator. So most of you are fully aware that for the last 7 or 8 months, outside of maybe a month or two of good performance, the market's been in a steady decline. That's what happens with the market when the market is fearful of a recession or a slowing economy. The market tends to sell off in advance, trying to make some type of prediction about what might happen with the economy in the future. Also, statistical evidence would point out in the past that the market typically will start some type of recovery phase at or near the end of a recession, and maybe even possibly before the recession is over. Now, we don't know for certain how all that's going to play out in the past, but history has shown that the market tends to sell off in anticipation of a recession and tends to improve shortly before the end of a recession and moving forward. In fact, if we look at the data, price changes before a recession end date, there are many times 1 month before, 2 months before, 3 months before the end of a recession that the market's actually starting to improve. Then if we look a little further out at the price changes after a recession end date in the market, and we look out 3 months, 4 months, 6 months, 1 year after a recession end date, most of the time, there are 1 or 2 exceptions, but most of the time the market is markedly positive following those months following a recession end date. Again, we won't know what the recession, if we're in a recession just yet. We won't know exactly when that recession is going to end. By the time we know that, things will likely have improved. That's why so many investors waiting to get into the market sometimes are very disappointed that they didn't get near the bottom in prices, because they were waiting for things to get better and get an all clear that we're out of a recession, all of those type of things. When maybe, at least in the past, the best thing what to do would be to invest with managers, invest in strategies when the market is going down. Not try to get all of it in at once and try to make an absolute guess on what the bottom of the market is, but not sit with every bit of our money idle when there's opportunity.